That initial drop in yields after the Fed's meeting yesterday has picked up even more steam today. The 10-year Treasury, remember, was at nearly 4.25% just on Monday, and today was down in the 380s. That plunge means the 30-year fixed mortgage rate is back below 7%, all the way down to 682, if not lower today, and that's its lowest level since mid-May. Let's bring in Matt Graham here. He's Mortgage News Daily's chief operating officer. Matt, I'm seeing numbers even, 6.6% now.
That's right. Yeah, 6.62 was what I updated it to a short while ago. It's been a staggering two-day move, one of the biggest two-day moves we've seen.
Unbelievable. And then people were already running the analysis on social media, but saying, if you were one of the people who had to, unlucky few who had to buy at 8%, it probably already makes sense to refi.
Yeah, I mean, definitely that's the calculus, right? Sometimes as little as 0.5% can motivate somebody to refi, depending on what their motivations are, whether they need cash out, et cetera.
So what do we make of this dynamic for the housing market? 6.6% is still much higher than most people in their 40s, whatever their home buying audience is, are used to. It's better, but it's not great.
Right. Yeah, that's how they get you, right? Now we're excited for rates to come down to 6.6%. I think when rates were moving up and over 4 and 5%, this would have looked pretty bad. So everything's relative. But for sure, we've already seen the application data start to pick up even before the last 2 days of gains, talking about MBA's mortgage applications, and in the refi category as well. Now, they're picking up from historically very, very poor low levels, but picking up nonetheless. And there's definitely a buzz that is increasing in the housing and mortgage market over the past 2 days.
What would you expect the rate to be into next year based on what the Fed said yesterday?
Oh, yeah, that's good. Get me with the predictions, right? I love those. So, look, the rate momentum is as good as the trajectory of economic data. So if the data continues to do what it has been doing, there's no reason rates couldn't go down into the 5s, possibly even high 4s if, some of the talking heads are right about recession in 2024. That's not unreasonable to think that we could see that territory that quickly. But it really depends on economic data, chiefly inflation, getting to the 2% target.
And quick final question, but as most people in the market are well familiar, the spread is still historically wide. And is there any sign of that normalizing?
I wouldn't say there's a sign of it normalizing. It's coming down, and it makes sense to me where the spread is given the rapidity of the move toward higher yields, and it is something that should naturally come down as rates overall come down and as volatility sort of dies down.